one of the biggest things we're going to pay is healthcare and taxes.
Mm.
So, I mean, those things are coming. So we might as well be proactive.
We'll be talking about the state of the economy and the case for planning right now as an opportunity on Financial Focus Today with John Kuykendall, founder of GulfCoast Financial Services. We know that planning is important, but for some reason, we continue to put it off. We let that thought linger in the back of our mind, but ignore it or procrastinate. Why would we turn away from something that we know we need to do, especially when circumstances and conditions, the environment for planning right now is an opportune moment, almost ideal for getting your plans put together? We'll talk about those factors today on Financial Focus with John Kuykendall. Again, founder, CEO of GulfCoast Financial Services. They've been named best of the best in financial services 10 straight years and running by the readers of the Lake City Reporter. And John, when you got clients coming in with that plan put together, smiles on their faces, you know why you continue to get that vote of confidence.
Well, that's right, Peter. But unfortunately, a lot of people they think we're going to live forever. Retirement is something that's so far in their future that they can't really realize it. But it's going to be here before you know it. And so, the best time to do a plan is in the very beginning. If we could get people to, when they get that first job, start planning for retirement, that would be a glorious thing. But I don't think we're ever going to get there, Peter. So we're just going to have to plan. Anytime's a good time to plan. It's certainly better than no plan, as we've said on this show many times. You need an income plan in order to be ready for retirement. There's too many things that make retirement complicated, and there's still taxes. We got more health care. All these things go into play, and we have to prepare for them.
Is there a best time to do planning or a deadline for when we've waited too long, John? Because I feel like procrastination just somehow takes over in those questions.
Well, I think a lot of people think, well, I'm in my company 401k, so I'm planning. But that's really not planning. What that's doing is just putting money into an asset bucket. But there is no bad time. I mean, I've got clients that are in retirement and we still plan because we have to. We have to prepare for the future. We have to prepare for legislative changes, tax changes. We have to know how that's going to affect their plan, and so that we can implement the best plan that we can do for them to give them the best retirement. So there's no one time that's good. We just need to plan, Peter.
Well, the motivation is there, ladies and gentlemen. The reminder from John Kuykendall, you need to get a plan put together. But John, specifically the state of the economy, where we're at with several factors that play into planning, does make this an opportune moment to do so. So let's talk about some of those factors. We have had and continue to have a very strong stock market. Isn't it better to do our plans while we are seeing an advantageous and high stock market?
Well, that's right, Peter, because what we can do is, even though the stock market is high and we have had a tremendous run up, we can still do dollar cost averaging. So every time you put money in your 401k or your IRA, what you're doing is you're buying stocks at that price. And so you'll buy low, you'll buy high, and we'll continue to average out. And so that gives us the advantage. But the market's been so good to us, it continues to come down, but then it comes back up. And so being in the market is better than not being in the market at all.
And as it's rising, another opportunity. And if you've planned efficiently, John, even those temporary downturns that we have seen can be advantageous opportunities.
Well, that's right. We're in a really strong market. We've got a healthy economy. Earnings continue to be increased, even though we have all the things that we have, inflation, tariffs on the horizon, interest rates. Are we going to lower them? Are we going to raise them? All those things which create a buzz around the market hasn't been able to keep the market from going up. It still has momentum, and we've got We've got strong market that will continue to grow. And so we need to be in that market and we need to have a plan on how we're going to invest and how we're going to get in it. And that's certainly something we need to do.
And John, we have constantly and repeatedly talked about and warned against trying to be a market timer, but planning proactively while the market is high is not market timing.
That's right. It's not market timing. We're not trying to time the market. What we're doing is trying to take advantage of what the market does. And so I think, Peter, we have to be tactical. We have to be proactive. And so the market is going to give us certain things every year and it's going to take away. And so what we have to do is continue to plan to make the changes in our 401ks and in our retirement accounts and in our brokerage accounts so that we can get the most return out of the market, but certainly not try to time it.
And remember, whenever you are dealing with the market, it is always kind of a long-term focus and time horizon. Retirement typically is 20, 30 years or more. And if we're still in our working career, can be years away. It's critical to take advantage of the market, but keep that long-term time horizon perspective in mind as you go through the ups and downs and take advantage of them by having that plan in place. And again, we're talking about the reasons why right now is an opportune moment in time to get your plan together or to revise and review your current plan with John Kuykendall. Reason number two, John, why it is such an opportune moment: low tax rates that are not promised to be with us forever.
Well, that's right, Peter. We've talked about low tax rates. We've said that, the taxes will get redone or we'll have new taxes at the end of this year unless they get extended. And so all the time, legislative changes are happening, and we have to take those legislative changes and implement them in our plan. We can't continue to not worry about that. Taxes are going to go up. We know that. We have, because of rising debt, the cost of the government, things are going to cost more and inflation. So we need to be proactive while we have low tax rates and then be able to be more proactive when the rates go up so that we can keep our tax bill down. One of the biggest things we're going to pay is healthcare and taxes. So, I mean, those things are coming. So we might as well be proactive. And, Peter, what you said earlier, we have 30, 40 years of working experience, but then we've got 20 to 40 years of retirement, depending upon when you retire. And so some cases, we're going to be retired as long as we worked. And so we have to plan in order to be able to pay ourselves in retirement.
John, isn't inflation just sort of an offshoot, a de facto secondary tax?
We get a wage increase. Well, things go up. We get more inflation. So inflation cost makes us pay more for the goods and the services we're getting, which takes away money out of our pocket for normal everyday things that we need. And so it's just like a tax, and we have to plan for inflation in our retirement. A dollar today, Peter, will not buy tomorrow what it buys today. It just doesn't work,
What was
I
that
mean,
guy's
that's
name from
70.
Popeye? I'll gladly pay you Wednesday for a hamburger today.
Yeah, that's 70 Chevelle, which was $5,000, isn't $5,000 today.
Yep. Inflation is going to not only play into planning, but remains a constant factor. Not the rate of inflation that
No.
we have obviously seen is not constant. That ebbs and flows. But having to deal with inflation is something we will constantly have to plan for and continue to monitor. And John, speaking of these low tax rates, why are we worried about taxes into the future? Well, you talked about spending, you talked about debt and deficit. Over the course of the next 30 years of retirement forecast, we are going to have to, I believe, address this debt from some angle. and we can't cut the mandatory spending. Congress doesn't like to cut their discretionary spending. So there's only one corner of this triangle that can flex to solve these problems, and that is the amount of tax revenue that the government brings in. And oh, by the way, just for historical perspective, right now we're currently in historically low tax rates.
That's right. And you know, the government is either has to cut spending or raise taxes. And you just said they're not going to cut spending. We're trying. There are some proposals now to cut out some of the waste, but that's never going to happen totally. We're going to need more money. We've got this huge debt, and you know, we're facing Social Security only being able to pay out 72 cents on the dollar in 2033. We're looking at Medicare running out. And, you know, with this new Fair Social Security Act, which is going to put thousands more at a full Social Security retirement, civil workers, that's going to make it run out even quicker. So we have to do something, Peter. And one of the things that, you know, worries me, Peter, is that you know, I may be doing great now on what I have, but when we get all these tax changes and we see how this is going to work, and I believe we're going to be indexed for income, I may not have the guaranteed check from Social Security that I'm getting now. And I may not be able, all of my medical costs may not be paid by Medicare. So how am I going to handle that? How is my plan going to take care of that for me?
Yep, we've got to plan for that, address that. These are the things that we put into planning. And again, John, why right now an opportune moment? But we do worry about the potential impact of legislative change, of tax policy change on retirement savings and the retirement streams of income. As you mentioned, Social Security wrapped into that as well. So we've got to be cognizant of the fact that right now is an ideal time to be planning, capitalizing on these lower current tax rates is a big win for retirees and those who have done a large portion of their savings specifically into those tax deferred accounts, John.
That's right. And those tax deferred accounts are going to be taxed, Peter, as they come out. So, you know, right now we may say, well, 20% of I'm in the 20% tax bracket because we have tax brackets. So, you know, 20% of my IRA is taxed, but it could be 30%. And so we have to be careful how we work the tax brackets, and we have to look for how that changes in the future and then adjust accordingly. One of the things that people don't understand is this bracket situation. You know, the more money I take out, the more I have to pay. And so I could take out an additional dollar and it could cost me 40% if I hit another tax bracket. So people just don't understand that.
Yeah. Well, again, we're talking with John Kuykendall, founder, CEO at GulfCoast Financial Services. If you've got questions, if you'd like to get your written, financially focused income plan put together, you are welcome to be in touch with the team, 386-755-9018, 386-755-9018. And when it comes to planning, a lot of times procrastination does take over. And that's why the theme of today's episode is we are reminding you why right now is an ideal time to get that plan put together or to review and revise your current plan. John, reason number 3 why right now is an ideal time. We have available to us higher interest rates for the more conservative saver or the side of our portfolio that we don't want as much risk with.
Well, that's right, Peter. In our income bucket or our safe bucket, we've got higher interest rates on CDs, fixed annuities. You know, they're paying more out. We've got the ability to make more money on that than we've ever had in the past 30 years. And so we need to take advantage of that. Higher dividends on stocks. Stocks have to continue to pay out in order to be attractive. And so there are dividend stocks, AT&T and some others, for example, that have nice dividends, and they will continue to raise those. And so, you know, it just gives us a way to make more money without having to take the risk of the market and diversify our portfolio.
Opportunity to lock in longer term fixed rates that are higher than what we have seen in the previous 15 to 20 years. Right now, that's kind of the current environment that we are in. Improved real return potential for lower risk investors. That's what these higher interest rates means. Also reducing the risk to inflation on those dollars that you're not taking risk with. All good beneficial things, and making the case for proactive planning and evaluation right now, John.
That's right, Peter. It's a great time. And people need to understand that we need to diversify our portfolios, especially as we get closer to retirement. We can't have all of our money in the stock market hoping for growth and hoping for double-digit returns. It doesn't happen. And so there is a certain portion of our portfolio that needs to be for income and for locking in, as you said, these higher interest rates. Great time. I'm always reminded, Peter, of the time back in 2000 when an annuity company had a 10% fixed annuity. And they were touting, you could put part of the money in their variable annuity and part of the money in their fixed option. And in, 7 or 8 years, the fixed portion would grow back to what your principal was. And so you really couldn't lose in the other portion. And nobody wanted it because in 2000, the stock market was doing so well that nobody wanted to talk about that.
I remember, John, that people were ripping equity out of their homes to invest in the market, and that got a lot of people in trouble when the dot-com bubble burst, and the investment that they had made with borrowed money against their home lost value. And I think that alone had some factors in reforming what you could do with home equity
Oh,
funds.
yeah.
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 Oh, and we don't know what the future holds, right? Back then, it
Yeah.
seemed like it was going to go on forever. And kind of right now, we almost could get the same sense that, hey, this advantageous and generous market is just going to continue on forever. But the reality is that it's not. And that only by planning and executing on strategies can we be better prepared for whatever outcomes we face into the future. And John, we've given 3 reasons why right now is an opportune moment. On the other side of this, I do want to talk about demographics, and can these conditions last forever, given the fact that we're hitting the peak of the bell curve of baby boomers now transitioning into retirement and becoming withdrawers from their funds rather than contributors to their accounts?
Well, that's right, Peter. We're taking money out now as we reach our required minimum distributions and also as we retire and need income. So, I think the potential for growth stocks at some point is going to wane. Harry Dent started talking about the baby boomers back in the 2000, late 90s, 2000s.
Yeah, and I remember his name and his books from the early 2000s talking about the great boom and the great bust ahead, right?
Right, because we were going to have this huge wave of baby boomers coming through the market. Things were going to be good, and then they were going to die off, and the next generation, it wouldn't be as good because we have this huge bunch of savers and people that have put up a lot of money
Yep.
for retirement because we're the ones that have benefited from the 401k legislation. And so, there's going to be pressure on growth stocks. We know that as baby boomers retire and start taking money out of the market, stocks are going to have to, sell. There's going to be more volatility, more turnover on portfolios as we do this, more market volatility just because of that, um, and a long-term slowdown in equity demand.
Yep.
But that's what we have to be ready for, Peter, in that the income plan that we talk about, the financially focused income plan, it takes into consideration how much income you need now, how much you're going to need in the future, how we're going to allocate it based upon a growth bucket, an income bucket, and a safe bucket for those short-term emergencies. And we're going to put that all together and then we're going to monitor it. And as we evolve through this thing, we will adapt with it. We don't know really what's going to happen to the stock market in the future. We can't predict it.
Right.
I mean, if we
No,
could. we
Yeah.
wouldn't be here, right?
No. Well,
But
I think we can never know the future with certainty, and that
no,
predictions have been wrong as long as they have been made. But sometimes, and those predictions from Harry Dent are sort of he was a Harvard economist, wrote several books, was all over the news for a period of time with his predictions made in those books. Sometimes, in thinking of Harry specifically, predictions aren't wrong; they are just ahead of their time, and
yeah,
we don't know what the future of the market holds. But John, looking at another economy as an example, I know Japan's economy hit the peak of their baby boom in 1990. And from that point, for the next 30 years, their market had did not fully recover from where it peaked around the time that the baby boom generation in Japan peaked, which, by the way, like, again, not the same economy as the US, but back then Japan was looked at as like the model of
oh,
efficiency and that they were going to
yeah.
take over the world.
Well, yeah. We had a lot of economists over in Japan talking about how to do things right. There were books, I can't remember the names of now, but there were 3 or 4 books that was written that actually came over here and we implemented them in our industries because Japan was the epitome of how to run a corporation. And so, yeah, but that market, as you said, slowed down. It began to tank because of their moving population, and they're just beginning to recover. And it's still not totally there. Now, Harry Dent wasn't wrong. He was just, 15, 20 years ahead of his time.
Or
We
maybe a little
finally,
exaggerated on the numbers,
yeah,
right? We don't know.
we got to Dow 30,000 eventually, but you know, it 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 wasn't as soon as he thought it was going to be.
Right.
And so, everybody gets their 5 minutes of fame. And the way that we can take that risk out is by planning. If we plan, then we can adapt to the market as it changes. We can adapt to legislative changes, which are going to be astronomical in the future. I mean, legislation has to continue to change because, as we need more money for this or that and pay debt, interest rates go up. It hurts us because we have to pay more interest on our debt. Interest rates go down, banks get hurt, the economy, that side slows. So there are a lot of things that happen, Peter, and we have to be ready for them. The only way we can do that and plan for taxes is by planning.
Yep. Yep. John, finally here, we've talked about a number of different factors making the case as why right now is an opportune moment economically to put our specific individual plans together. Final factor here we're going to cover on today's program is that the baby boomer generation, the generation retiring right now, has amassed more personal wealth than any previous generation, and yet still so much doubt and uncertainty about maintaining our lifestyles through retirement because we don't have the same guaranteed income as previous generations. But, and here's the reason why now is an opportune moment, guaranteeing yourself payout rates with
Mhm.
benefits for retirement income also at a very advantageous and opportunistic point. We can generate a lot of income from a lump sum.
Well, that's right, Peter. We're getting higher interest rates, but we're also getting higher payout rates because we're finding that people are living longer. And so that actually helps us actuarially is that the payout rates are higher. So I'm going to get more money per month. But there's something about being able to go to the PO box or your mailbox, and every month you get a check because that gives a certain amount of certainty and higher payouts, guaranteed lifetime income, protection against inflation, protection against the market. All those things are reason to why annuities are a great way for us to bridge the gap between income and growth. And so we can't have all of our money safe, but on the other hand, we can't have all of our money at risk in the market.
Right. Yeah, you have to have that balance. But so many different factors, economic conditions, the
Mhm.
interest rate, the tax environment, the market conditions make the case why now is an advantageous moment in time in history to do our individual planning. You must have a plan to get your financial life in order and your financial goals into the future. achieved. You've got to plan for those things. And at Gulf Coast Financial Services, they put together the written financially focused retirement income plan. No cost, no obligation. Yet another reason why this is such an opportune moment to take advantage of. But there is no cost. Leave the checkbook at home. Maybe it's not just procrastination. People are worried about the pain or the cost of speaking with an advisor and getting the plan put together. Let's take that out of the conversation, because you can give Gulf Coast Financial Services a call, talk with John, talk with the team, sit down, get your plan mapped out and put together. And again, no cost, no obligation. All you need to do is pick up the phone, get the conversation started, give a call to 386-755-9018, 386-755-9018. 386-755-9018, or you can visit online, gulfcoastfinancial.net, gulfcoastfinancial.net. John, always a pleasure. I appreciate the time, and of course, you always sharing your insights and guidance and perspective with the audience.
Thank you, Peter. And I got to tell you now, that plan's going to be human generated, not AI generated.
Good. I think that, AI has its uses. It's certainly capable of doing a great many things, but individualizing something, I don't think is one of its strong suits, right? It's sort of just, here is the same answer I would give to everyone.
Right.
And the same plan doesn't apply to everyone.
No, the same plan does not apply to everybody. Everybody's plan's different and everybody's needs are different. And so it has to be done individually, and that's the way we do it. Yeah. Thanks, Peter. Have a good week.
Always a pleasure. And remember to get your individual, custom designed, written financially focused income plan. Pick up the phone, give a call, 386-755-9018. Once again, always a pleasure, John. Good seeing you here on Financial Focus.
Be sure to like, subscribe, share, and tune in for more Financial Focus by visiting GulfCoastFinancial.net. The information presented on this program is provided for informational purposes only, without warranty of accuracy, completeness, or suitability for a particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature and not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs. Early withdrawals may subject the owner to penalties, fees, or taxes. John Kuykendall is registered with and securities are offered through Kovac Securities Inc., member FINRA SIPC, found online at www.kovacsecurities.com. Advisory services are offered through Gulf Coast Financial Services Inc., a registered investment advisor in Florida. Gulf Coast Financial Services Inc. is not affiliated with Kovac Securities Inc. or Kovac Advisors Inc. Past performance is not indicative of future results. All investing involves risk. Investment decisions should be based on your own goals, time horizon, and tolerance for risk. Due to various factors, including changing market conditions and/or applicable laws, the content may no longer be reflective of current opinions or positions. Gulf Coast Financial Services Inc. has been named as Best of the Best since 2015 in the category of Best Financial Advisor in the Lake City, Florida area. The award was based on receiving the most votes in this category from a survey offered and tabulated by the Lake City Reporter. No direct or indirect compensation was provided to the Lake City Reporter and/or any raters, and the award is not contingent on future direct or indirect compensation offered to the newspaper and/or raters. Portfolio performance is not a criterion, and voting is open to any readers of the newspaper.